The third leg of the investment tripod is investing for growth. And this is, at least in my opinion, one of the most simple things that you can do, because you have only two choices here. One is equity and the other is real estate. When we look at the average person's working life of 3 or 4 decades, these are the only two avenues of investment, not just in India, but worldwide, that have given tax efficient, inflation beating returns, especially when the period of investment is 10 years or more. I repeat this, it's not just in India, it is worldwide. Eric Tyson, a very good writer, he's author of a book called Personal Finance for Dummies. Don't be misled by the title. That book is definitely not for dummies. It's for intelligent investors, and I would certainly advise reading that book. I've read the last 4 or 5 editions. Eric Tyson has a slightly differing view. Eric Tyson says he agrees with equity, he agrees with real estate, and then he also adds your own small business. And that is absolutely true. If there are any of us in this hall who have been in businesses which have been established, we know that neither equity nor real estate can ever beat the returns of a business run by you over a long time, which has stabilized and is successful. Here the rate of return is far higher than what you would get in public equity, like your diversified portfolios of stocks or equity mutual funds. There's no doubt about that. It has to be. Otherwise, the economic principles do not work. I would be a fool to take a much higher risk in one single business if my returns are not higher than what I can get in a diversified portfolio of stocks. It's as simple as that. The reason why I did not put this particular thing back here is simply because, whereas any normal person with a little bit of common sense, I don't even say intelligence, with a little bit of common sense, can invest both in equity as well as in real estate. Business is not for everyone. If it is for you, by all means go into entrepreneurship. If it is not for you, you should not get into it. So I was trying to deal with something that everybody can do. And that's why I took equity and I took real estate. There are so many myths about equity. The moment I say that everybody can get into equity, people immediately say, no, it needs study, it needs research. Nothing of that sort. Nothing of that sort. Today's program, I understand, is sponsored by a mutual fund called Goldman Sachs Mutual Fund. This very mutual fund has got an index fund. I think it's called the Goldman Sachs CNX 500 index fund. It tracks the NSE 500 index of the National Stock Exchange. We are all familiar with the Nifty. Nifty tracks the 50 stocks. This tracks 500 stocks. If you have got 1,000 rupees per month, 1,000 rupees per month, you can register yourself for an SIP into this fund. And your 1,000 rupees gets distributed among India's top 500 companies. Please tell me, what could be easier than that? There is no study you have to make. There is nothing you have to track. Just register this SIP for a minimum of 10 years. Or if you are a youngster, age 30, register it for 30 years, till retirement. That alone may build you a large enough corpus to retire comfortably on, especially if along the way, from time to time, you can slowly increase at 1,000 a month to 2,000 a month. And then 3,000 a month. Once in 5 years you do it, that's enough. So nothing can be simpler. You don't need study, you don't need graphs, charts, technical analysis, fundamental analysis, research reports. I will destroy all of those things a little later in today's program. But right now, you'll have to take my word, I'll prove all these things later, that for a normal person, equity and real estate are the only two avenues of investment worth considering for growth investments. And if you have entrepreneurial talent, then by all means get into entrepreneurship, because there is nothing as profitable. The Bombay Stock Exchange Sensitive Index, the first trading day on which it was quoted was 3rd April 1979. Don't be fooled by that base year of 100. They say base year was 100. Yes, base was only a statistical base on some date in 1979. But the first time it started getting quoted was 124.15 points on the 3rd of April 1979. And yesterday, the market closed at 29,231 points. If you take the period in years, it is very close to 36 years. And it is a good thing that we are having this program at this juncture, because this 36 years is almost a normal person's working lifetime. The returns are 16.44% compounded annualized. You did not have to do anything. If there was an index fund in 1979, there wasn't in India, but if there was, you have to just start a simple SIP into that index fund to get 16.44% of returns along the way over this period of almost 36 years. And if you look at real estate, here I'm of course on very weak ground, because this is the best estimate that I have got from some of the real estate experts who are our clients. Roughly the same returns. Real estate in India over this period of the last 3.5 decades has appreciated 250 times. But real estate is so very different. You can have 2 plots of land within 50 meters of each other on the same road of the same city, but the dynamics can be different. The dynamics can be different. So it's almost impossible to estimate what return somebody would have got. There could be people who have got 1,000 times. There are other people whose land might have been acquired by the government. So you've got these 2 huge extremes. One would have suffered losses, one would have suffered super profits. Why I have taken this figure is from my discussions with some of the people who are knowledgeable about real estate, and also from a study that is now approaching 30 years in the United States, where it has been found that in the very long run, and the very long run is at least 30 years, returns on equity as well as real estate in the United States are approximately equal. Approximately equal. Moving ahead, of course, the compounded annualized growth rate roughly the same as equity. What about gold? You can ask a question about gold. I take the quotation of Timothy Green, who is a bullion expert. He's not an investment expert, he's a bullion expert, a gold expert. He says, the great strength of gold throughout history has not been that you make money by holding it, but rather that you do not lose. This is where he has really hit the nail on the head. If you see in the long run, gold is not a growth investment. Gold does increase in value, but its rate of increase is approximately equal to inflation. I will give you the figures a little later. It does not beat inflation, it preserves the value of money. You do not lose. But it's not that you make money by holding it. Your wealth does not increase. And of course, even if you're talking about investment in gold, going through the jewelry route is utter foolishness. Because you lose at every stage. At every stage, making, remaking, whatever it is, the jeweler is the only person for whom gold would be a genuinely good investment. But if I'm talking about either bullion mutual funds or buying and then preserving very carefully things like your coins or biscuits or bars, if these things are available to the normal persons. I now turn to real estate. I must say that in last 3 weeks back when we met, in that presentation and today's presentation, I am on my weakest ground where real estate is concerned. Because I am neither an investor in real estate, I do not like real estate in the physical form, nor am I an expert in real estate. So this particular portion, I have sort of constructed from my experience, and I am fortunate in one respect. Among our clients, there have been leading promoters as well as other consultants in real estate, not just in this city, in other cities also. One of my close friends is an expert in real estate in Mumbai. So taking all their inputs from time to time, I'm just sharing a few insights into real estate. There is absolutely no doubt that real estate is an excellent long-term wealth-enhancing avenue of investment. There is no doubt about it, along with equity. But it has some drawbacks. We should always be aware of these drawbacks. The first and most important is poor liquidity. You can complete a mutual fund transaction in maybe 15 minutes. You can complete a banking transaction that fast, or probably do it off your smartphone. In bad times in the real estate market, it is difficult to buy or sell even prime property. Even at the height of a boom, you cannot conclude a real estate deal instantly. There is a time-consuming, cumbersome process to complete real estate transactions. Liquidity is very poor. There are a lot of steps you can take to safeguard title, to investigate title, engage the best real estate lawyers, go for the best projects. But to an uncomfortably significant extent, even years after people have bought properties, there are sudden, unexpected, sometimes shocking challenges to the title. Somebody will make a claim. It may be a false claim. Ultimately, the person making the claim may not succeed. But it can cause much heartburn, much tension and stress to the purchasers of real estate properties. You cannot buy real estate with small amounts. I give you the example of the Goldman Sachs CNX 500 index fund. With 1,000 rupees a month, you can buy into 500 of India's largest companies. You cannot buy a flat with 1,000 rupees. Even if you are taking a loan, the down payment that you have to make would run into lakhs of rupees. To make an additional purchase, also you need significant amounts. It's very simple to imagine this. You have 1 crore of rupees. You have read that equity and real estate are very good growth avenues. You put 50 lakhs in real estate, 50 lakhs in equity. Unfortunately for you, in both markets, you have invested at the very peak. Both fall down significantly in the next 2 years, 40% fall. Your equity portfolio goes from 50 to 30. Your real estate apartment or whatever you have bought, when you see, ask around in the market, that 50 lakhs has also become 30 lakhs. Now you are a hardcore investor, you are not going to panic. Your thinking is, I must seize this opportunity to make additional investments now. But now you go to your bank account. In your bank account, unfortunately, there is only 10 lakhs. You cannot buy an apartment for 10 lakh rupees. But you can definitely buy equity shares for 10 lakh rupees. That's what I meant by this point. Even to make an additional purchase in real estate, you still need significant amounts even after a fall. In equity, you can even put 1 lakh rupees. It's much more flexible that way. We are all aware of the menace of black money transactions, high stamp duties when you purchase real estate. In equity, when you purchase any amount, the stocks are credited to your demat account absolutely free of charge. There is no stamp duty on them. When you sell, of course, there is something called the securities transactions tax. But that is so insignificant as to be negligible. You need not even take that into account. Purchase and sale formalities are cumbersome in real estate. And a very, very important factor, the last factor there, administrative difficulties. You can buy real estate if you are not on the spot. There can be squatters. Somebody will shift your survey stone. Somebody will damage your compound wall. Somebody will encroach. As the prices go up, there is the presence of the land mafia, especially in the metros. And one more factor that we are recently coming across more and more, the last one they called aging landlords. A lot of people have built up significant real estate assets. Unfortunately, these people are not or do not have a proper line of succession to take care of the assets. Lot of people sitting on valuable real estate, their children are abroad. Their children have no intention to come back. It becomes difficult for these people as they age, as they cross into their 70s, 80s, to renew rental agreements, to take action if a tenant is giving trouble. We are seeing more and more of these. So after some time they ask their children, and virtually in frustration they sell them off. These are some of the things that we should be aware of. One more problem with real estate is, when we account for the real returns in real estate, we make the same mistake as the bank fixed deposit. 9% interest rate is not a 9% interest rate when I'm in the 30.9% bracket. It is 6.22. I've got a 2-bedroom apartment. I'm getting 13,000 rupees of rent per month. 1,56,000 rupees of rent per annum. In my mind, I'm getting 1,56,000 rupees of rent. We conveniently sweep under the carpet the actual expenses incurred on maintaining and preserving that real estate, which can be quite a lot. There is the periodical painting and whitewashing, any amount of repairs, renovation. All these things are paid out of, not the rental. They are not accounted against that. There is no total rental minus expenses. We don't keep records. Where do we pay? From our normal income or from any other liquidated assets. I've hardly come across anyone maintaining those accounts. I was not doing it, not that I have extra real estate investments. But I hold the powers of attorney of a number of my relations and 1 or 2 very old clients to look after some of their properties here. So when I do that, I am forced to account for all the expenses correctly. My firm does it. There I see what are the rentals received versus what are the actual expenses. And in real estate, let me tell you, a significant portion of the so-called income is eroded because of expenses. It can be simple things like monthly maintenance to an apartment owners association, contribution to a sinking fund, all sorts of repairs, all sorts of upkeep. And please note that while land may appreciate, a building always depreciates. So the depreciation expenses also, when they are written back to a book, then your eyes get opened. Property taxes is another thing. Take the stamp duty and taxation. Just to give you a quick example, supposing you have 200 lakh rupees, you put 100 lakhs in equity, 100 lakhs in real estate. The 100 lakhs of equity comes into your demat account. But for you to become the owner of the real estate, you have to pay stamp duty and registration fees, which in the state of Karnataka today are about 7%. Immediately you have an equity advantage here of 7 lakhs. And when you sell, although there is the securities transaction tax, I told you it is so negligible as to be laughable, so we discount it. But I have taken here an average figure of 12% of long-term capital gains tax that you have to pay when you sell real estate. Sometimes you have to pay more. Once again, you have an equity advantage both on the purchase and sale of real estate. We have to understand that. So the taxation on real estate is much higher. Actually, the government can do something in this regard, but why we are so slow in moving on this is because of our constitution. Where income tax and other things are concerned, including equity investments, it's a central government subject. But real estate is a state government subject. So each state can formulate its own rules, charge its own taxes. That's why there's no uniformity. If you are a real estate investor, you have choices. Agricultural land, of course, is not for everyone. But from residential properties, whether an apartment or a house in a small plot of land, to various forms of commercial space, you have one last option which is very popular abroad, called the real estate mutual fund. Unfortunately, genuine real estate mutual funds, Indian mutual funds I'm talking about, have not started so far in India, simply because the SEBI regulations don't permit them. They permit them, but the regulations are a little unworkable. So no mutual fund has really come out with real estate mutual funds. I hope that changes, because that could give normal investors an opportunity of investing in real estate. One of the questions that a common investor asks is, should I invest in real estate? Is real estate for me? And the best answers that I have received and I have passed on to investors is, when we look at real estate, we fall into two categories of people. There is one category of people who are genuinely interested in real estate. They have a talent for it. They are willing to spend time on it. They are willing to talk to a lot of people, make their own studies. They are genuinely interested in real estate. They are in the know of what is happening in the real estate market in a particular place, sometimes in more than 2 or 3 places. Now, if such people want to get into real estate on the investment front, by all means, please get into it. I can give you any number of examples. There was somebody who was a non-resident. The person knew that investing in bank deposits is not going to help me in my old age. He could not understand the stock market. So what he did was, along the way, he kept investing in real estate. Made his house, then continued to invest in real estate over a period of, as of today, 45 years. In 45 years, he purchased a total of 7 pieces of real estate. Some of them in Mangalore. The person he married was from Mysore. So some of them in Mysore and a couple of them in Bangalore. Today, the rent that he receives, he is just hitting 70 now. The rent that he receives is little over 2 lakhs per month. His expenses in Mangalore are 40 to 50,000 per month. Once again, he tells me, out of the 2 lakhs, it's not 2 lakhs minus my 40 or 50,000. There are the taxes. Apart from that, he says, as time passes, I have to spend more and more on the upkeep of the properties. But the fact remains that where he is concerned, real estate delivered to the extent that he can live comfortably off real estate. And if he finds things going too difficult, he can one by one start knocking off his real estate properties. So real estate has delivered. If you have this kind of a talent for real estate and interest for real estate, you are willing to work on real estate, please go for it. But when we come to the second category of people to which I belong, people who have absolutely no talent for real estate, no interest in real estate, the best experts advise to go in for real estate only to the extent that you have a use for it. This is very important. What do we mean by use for it? One use is a universal use. All of us require a roof over our heads. We require a house or an apartment. So everyone must try to own at least one house or apartment. Take a person like me. I operate out of an office. So I have a use for an office. Instead of renting out an office, at some point of time, I must try to own my own office. So now I have a house, I have an office, both of them are owned by me. Why? I have a use for both. Take one more example. A person who manufactures and sells furniture. Such a person requires a residence, another place little out of the way, but a large old house or a shed, where the workmen can actually manufacture the furniture, something like a workshop. And then this person needs a showroom in a very good location, with good road view, where the person can exhibit and market the furniture. Such a person must try to own all three over a period of time. I have a person I know who worked abroad for some time, then returned to Mangalore at a relatively young age. He had worked in interior designing. Although he had no qualifications, he had a certain amount of talent. So he went into interior designing in Mangalore and did very well. With the money that he had saved from his work abroad, he purchased an apartment. He purchased a showroom. And he also purchased, little out of the way on the highway going towards Bangalore, he purchased a house with a good concrete structure, a land with a good concrete structure on it. It was not a house, but it was a ground plus one concrete structure. That was where the furniture was manufactured. And he was also doing interior designing. Everything was going on well. One day he shut his business. I asked him why. He said, I can't get people to work anymore. So my reputation is in tatters. I can't deliver projects on time. I've got business, everything is good, but I just can't manage labor. So I've decided to wind up. He let out both these places, the showroom as well as the other place. From these two places alone, his income is a little more than 1.5 lakhs per month. This was possible because he was prudent enough to own the places he needed at one time. So those places could now be converted into rental income properties when he was not working. This is very, very prudent behavior. If you belong to a category which has a talent for real estate, an interest in real estate, go for it. If you do not belong to that category, purchase only real estate for which you have a use. One more mistake that people make is, when we look at real estate, we have to look at it from two angles. One is consumption, the other is investment. What is consumption? Exactly what I told you. When I live in a house, it is not an investment. I am consuming it. The house or the apartment is serving a purpose of providing me shelter. That is consumption. If I own an office and I am running a business or a profession there, it is consumption. I am consuming the office space to earn money from my business or profession. So all these are consumption. Investment is when you purchase something, you are letting it out for a rent. The two are totally different because the considerations that apply to these two are totally different. What are the considerations when you purchase something for consumption? When you purchase something for consumption, the effectiveness of the objective is very, very important. Take an apartment. If somebody is a family person, the entire family must approve not just the apartment, but also the locality, the facilities in the area. If everybody is happy, if the whole family is happy with what they see, a house or an apartment, now you go to negotiate for the price. You find that the seller is quoting a fancy price. Seller is not willing to come down. It is fine if you pay a price that is higher than the normal price simply because human happiness cannot be measured in terms of money. This has repeatedly happened. My own relation, many years back, purchased a house in Mangalore. Good location. She was very happy with the house. But even by my calculations, the seller was quoting 20-25% more. And then we came to know that the seller is a wealthy person. It is not a distress sale. The seller does not need to sell that property. The seller is selling it because seller has got enough real estate properties, wants to liquidate some. I told her, you are happy, your husband is happy, everybody is happy, buy it. Until today, she has no regrets. Similarly, a very good businessman I know, was in a commercial complex in the sub-basement floor. You can virtually say the basement. He was running a business was successful. He learned that above him, that's on that showroom quality space, the same amount of square feet was available on rent. So he gave up his premises, that also was leased in the basement, took this up. Now, just 3 months back, he contacted me saying the owner of this present premises wants to sell it. I asked him one question. You were in the basement. You came up here. When did you do that? He said about 2.5 years back. I said, what was your experience? He said, experience was fantastic. My business has improved 3 times, 300% in these 2.5 years. I said, then what are you phoning me? Go ahead and grab it. He said, no, he's quoting a fancy price. I said, forget your price, grab it. These are the considerations when you are looking at something for consumption. But when you are looking at it from the point of view of investment, the consumption considerations do not apply. Investment considerations apply. And the best advice that I have got for investment considerations comes from Professor Burton Malkiel, who some of his sayings we saw in the last session. And Burton Malkiel's advice is something that has stood the test of time. I myself have given it to people. He says, when you buy for investment considerations, there is a simple formula to be used. The rental yield must be equal to or greater than yield on short-term bonds. The rental yield must be equal to or greater than yield on short-term bonds. You see how different purchasing real estate for an investment consideration is from purchasing it for consumption. Here it is nothing but simple mathematics. An example. Cost of a 2-bedroom apartment in Mangalore, let us say, is 65 lakhs. You are getting a rent per annum of 1,56,000. What is the rental yield? 1,56,000 divided by 65 into 100 expressed as a percentage. Same as your bank deposit. I'm putting 1 lakh in the bank, I'm getting 9%. I'm putting 65 lakhs, I'm getting 1.56 lakhs per annum. Your rental yield is 2.4%. Burton Malkiel says that this rental yield must be equal to or greater than the yield on short-term bonds. Now, you may not be fully aware of the yield on short-term bonds in India. Let me tell you that that is about 7%. So, if you are looking at Mangalore today, it would be absolute madness buying an apartment for investment. For investment. Please understand this. Don't get fooled by our recent experience. There is a very important psychological handicap in behavioral finance. It is called recency bias. That is, because I have had a very pleasant experience recently, because something has gone up in price recently, I'm very comfortable with it. I believe that's the best possible thing. And the recency bias is very high in India, especially in Mangalore in the last few years, because between 2003 and 2013, we have seen a boom by which real estate prices went up 10 times in 10 years. 10 times in 10 years. If the price of land was 2 lakhs% on a particular road, very good chance of it having gone all the way to 20 lakhs% in 10 years. But about 1.5 years back, let's say in August or so of 2013, the real estate boom has very much ended. Today, I know the way promoters are struggling to sell apartments. Nobody is talking. Real estate market is dead. Ask any real estate agent who will give you a reasonably honest opinion. Things have changed very badly. And when the real estate market goes into a tailspin, it can go into a tailspin for a very long time. If you want to know the previous boom peaked in the latter half of 1995. and it went into a tailspin for the next 8 years. The next boom started only in 2003. So this is something that you have to be careful. You have to measure these things in terms of science, pure science, when it is for investment considerations. Consumption, of course, I told you, is different. So relying on Malkiel again, the rental yield must be equal to or greater than the yield on short-term bond.